I'd like to welcome everyone to the Buffett Center this afternoon. It's truly a pleasure to welcome our speaker, Professor Amar Bhidé, who is the Schmidheiny Professor, I think I got that right, at Tufts University, at the Fletcher School of Law and Diplomacy there at Tufts. Prior to his appointment at Fletcher, Amar had appointments in the business schools at Columbia, Harvard, and an unnamed school on the south side of Chicago. Anyone hold that against you? Amar was a founding member of the Center for Capitalism and Society. He is the editor of that center's flagship journal, which is also called Capitalism and Society. And his reach has extended beyond the grounds of the university as a prop trader at E.F. Hutton and as a consultant for McKinsey. Amar has, again, I'm sorry, I'm out of breath. I'm more out of shape than I anticipated. Amar has written widely and written extraordinarily well, I might add, on a variety of important topics. His 2008 book, The Venturesome Economy, links industrial innovation to the willingness and ability of consumers and businesses to make use of those innovations. The Venturesome Economy was recognized by The Economist as one of the best books of 2008. Amar's most recent work, is on the financial system. And it synthesizes a set of research extending back to the early 1990s that in many ways cuts against the grain of much of what constitutes modern financial theory. In his new book, which I hold here and which is available right over there, which is called A Call for Judgment, Sensible Finance for a Dynamic Economy, Amar explains how the financial system in the United States went off the rails. The book provides lucid discussion of the antecedents of the crisis, how a distinction from the 1920s between choice settings marked by risk and uncertainty was conflated in modern economic theory, and why that matters, how ideas emerging from financial economists led to the development of mechanistic top-down approaches to managing investment portfolios, and why that matters, and the skewed incentives provided by the system of rules governing finance and banking, among many other fascinating issues. I can tell you that I've tried my best to keep up with the raft of books on the crisis that have emerged over the past 3 years. And I can tell you that this is among the very best, if not the best, book on the crisis that I've read. There's something smart and illuminating on every single page in this book. I cannot recommend it highly enough, and I look forward to learning more from Amar both today and in the future. So please join me in welcoming Amar Bhidé.
So after that introduction, I thought I might plead laryngitis, because anything I say is going to only lower your potential assessment of the book. So that is incredibly generous, thank you, and it's very hard to live up to in this talk. So it makes ringing sounds. Okay. So I'm going to provide a brief look inside, and I cannot possibly cover all the stuff that's in the book. I was about to call it all the good stuff that's in the book, but that's self-promotion beyond reasonableness. So very briefly, there are two misinterpretations of this crisis. One is the two broad misinterpretation which Sarkozy and occasionally people from the left in the United States offer, which is that the entire system of capitalism is defective. And then there is the too narrow interpretation, which is offered frequently by my friends, my ex-colleagues down south, but not only. It's offered by regulators who were supposed to have prevented this from happening. It's offered by people from the financial industry. And the basic, the sense of their interpretation is, well, the financial system is more or less fine, but it's only that regulation had fallen behind what it should have been. I mean, so these great advances in the financial system, we just didn't keep up. I argue that both interpretations are flawed. I argue that there's nothing fundamentally unsound about the real capitalism and the real economy, that we have developed over the last 100 or so years an inclusive game of innovation that has provided unparalleled prosperity in human history. On the other side, I argue that the financial system is severely flawed, and that it undermines the real economy, and for the same reasons that it undermines the real economy, it is inherently unstable. I also argue that these defects are not things that have arisen because investment bankers suddenly became greedy in 2002, or because someone invented a particularly toxic instrument in 2003, but that these defects can be traced back to finance theory that goes back to the 1960s, if not earlier, and to misregulation. There's an argument which says that the financial system has been underregulated, which is a common view. Then there are people at the Cato Institute and AEI who say that the financial system is overregulated. I make the argument that we've had misregulation of the financial system. Since we live in an age of tweeting, I've tried to reduce the key propositions down to a single slide about what's gone wrong, not why it's gone wrong, because that's too hard to do. And I argue that a good venturesome real economy is characterized by decentralized judgment, and the decentralization is coordinated not just by the price system, but also by other mechanisms such as dialogue and relationships, and that this decentralization works to the degree that it is tied to real responsibility. I argue, in contrast, modern finance has become highly centralized and concentrated, that it has substituted judgment with mechanistic models, that it has more or less done away with communication, and almost as an inevitable consequence of the centralization and concentration, we have untied responsibility from the right to make decisions. So with that by way of preamble, my talk will concentrate on how modern finance undermines dynamism. I will describe what I think of as the crucial features of an innovative economy. I will then draw from these innovative features some implications for what a good financial system ought to look like, and then I will point to a dangerous and dysfunctional divergence from what a good financial system ought to look like and what we really have. I will say very little about what made finance pathological. And I think actually that's the most interesting part of the book. It's 7 chapters, but I've got to leave you some good stuff to read. And it's virtually impossible to cover in a short lecture. So I'll just sort of gloss over it, wave my hands a little bit, and move on. And then I'll spend a little more time talking about what I think of as a radical and retro proposal. So sort of where do we go from here? Curiously enough, there's yesterday I saw a review by Matt Iglesias. Matt Iglesias, as some of you may know, is sort of not exactly aligned in favor of capitalism in any form. And he had a very begrudgingly positive review of my book, and then he had a very positive review of some Aussie lefty guy's book. And he says, it's interesting that both these guys have two completely different views of how capitalism works and whether capitalism is good or not, but they end up in exactly the same place. So go figure. In terms of the solution. So I have a book now which the right hates in terms of its conclusions, but loves the analysis. The left hates the analysis and embraces the conclusion. So if I'm not pleasing anyone, I must be doing something right. So what does a good modern economy look like? And I've argued this at length in my last book, which is that innovation is a massively multiplayer game. There is a view which is popular amongst certain R&D circles and in Silicon Valley that innovation is an elitist activity, and it's undertaken by a few engineers and scientists, a few venture capitalists, and they produce all the good stuff that we live off. I argue that's a fundamental mischaracterization of innovation in the modern economy. That may have been an acceptable characterization at the time of Thomas Edison, when we had a few innovators producing stuff for a few rich guys, but that's no longer the case. And it's no longer the case because widespread prosperity requires widespread productivity improvements. It is impossible to have a prosperous economy in the broad sense if we are going to rely on the contributions of 2 or 3% of the population. So no matter how well Silicon Valley does, it is not going to make California prosperous. No matter how well Route 128 does in Massachusetts, it's not going to make Massachusetts prosperous. You need a system that brings up everybody's productivity. What this means is that it's not enough just to have new gizmos being developed, new iPads, new iPhones. We must also have effective use of these innovations. And for that, in turn, mere science or mere engineering is not enough. You need multi-level, multifaceted advances. You need good industrial design. You need sexy ways of selling the stuff. You need lawyers to build a good system of intellectual property around it. It needs everyone. And this means that the game, to the degree that it produces widespread prosperity, is one in which many people have to contribute and many people benefit. So it's not an elitist game by a very long shot. So the question arises how capitalism organizes this game. I argue that innovation works to the degree, or widespread innovation works to the degree that it's decentralized, case-by-case, forward-looking judgment. And each of these things is important. Decentralization, case-by-case, forward-looking, and judgment. The classic argument for decentralization was made in a 1945 American Economic Review article by Hayek, which was principally criticizing the problems of central planning and extolling the benefits of on-the-spot decision-making. And the argument Hayek made was that a central ministry of agriculture cannot make good decisions about farming because you need the farmer who has on-the-spot knowledge of the soil, of the seeds, of the weather, to figure out what to plant, when to harvest, where to sell it, and so on. And that the only information that can be communicated effectively and in a timely fashion to a central planner are 4 or 5 items of data. Everything else simply cannot be easily or quickly communicated to a central planner. The interesting thing about Hayek's article is that it said nothing at all about malincentives, or it said nothing at all about the limited intelligence of central planners. Implicitly, Hayek said that even if the central planner is brilliant, and even if the central planner has the public's best interests at heart, nonetheless, the problem of communicating this information is so severe that the central planner will fail to make good decisions. The other interesting thing about Hayek's 1945 article is that he said nothing at all about innovation, and he was merely talking about the problem of adjustments to economic change. Now, what happens if you throw in innovation? Now, innovation requires not just adjustments to change, because these adjustments could be made in a somewhat mechanistic way. A doctor goes through medical school, is trained to recognize certain sets of symptoms, and then basically maps the symptoms he sees into a diagnosis. Innovation is more than that. It also requires imagination, and it requires forward-looking choices. It requires thinking about the world not as it exists or has existed, but how the world might exist. And this in turn requires hunches. It requires both the on-the-spot knowledge that Hayek talked about, on-the-spot knowledge of what the technological options are, what customers want, but also some innate sense of what customers might want if I put this gizmo together. And these hunches are even harder to communicate to a central planner than is knowledge of on the spot facts. And furthermore, innovation tends to require iterative judgments. And you try something, it doesn't work, you try it again. And this process again is something which does not sit well with the process of central planning, where information has to be shoved up to a central planning agency. So when you throw in innovation, the case for decentralization becomes even stronger, not weaker, even though Hayek didn't talk about centralization. Now, Hayek and the people who follow him tend to take a pretty extreme view, which is it's decentralization and nothing but decentralization. Common observation suggests that that's not really the case, that in the real world, our freedom to act is limited by coercive and voluntary controls. We have to obey the law, and most of us work for organizations which, at least to some degree, tell us what to do. And these controls are necessary because of economies of scale. The manager of a Nike shoe factory cannot unilaterally decide what shoes to manufacture, what size shoes to manufacture. The shoe sizes are given to him by convention. The Intel engineer working on a microprocessor cannot again unilaterally decide what the specs of his piece of the microprocessor should be, because again you could not produce microprocessors on mass scale through this fashion. And we also need controls to regulate externalities. Time was when people rode around on horses and you didn't require much by way of rules of the road. But as we developed automobiles, we needed a traffic control system. As we developed, as we invented radio and television, we needed the FCC to tell us how to allocate the spectrum. As we developed a chemical engineering industry, we needed rules to control pollution. So it's not absolute. Nonetheless, I think it's fair to say that compared to any time in history, more people in the workforce have more of an opportunity, and indeed the requirement, to exercise their judgment in a forward-looking fashion than was ever the case in history. So it's kind of an interesting paradox. Robinson Crusoe is free to do absolutely what he wants, except he can't do very much except knock down coconuts. Mm-hmm. We are free to drive automobiles at 250 miles per hour, but we're not allowed to do that. So it's both the decentralization and widespread decentralization that permits us the opportunities to drive in a reckless fashion, and it's that which, but that's, I think, I mean, putting aside these limitations, we live, at least in the real economy, in a massively decentralized world, where more of us have this opportunity. I was reading a couple of weeks ago a little survey of management in the Harvard Business Review, and they talked about how 100 years ago, management booklets focused on how you control workers, Taylorism. Today, management is all about how you give the frontline workforce the opportunity to do what they want. So we live, by and large, in a highly decentralized world. So how is this stuff coordinated? The classic answer in Hayek and in economics textbook is through prices, and there is no question that prices are a crucial mechanism for coordinating autonomous activity. But they are far from the only mechanism. Dialogue plays an absolutely crucial role, and it plays a particularly important role in a dynamic economy. If we produced the same goods and services day in and day out, perhaps we could communicate without talking to each other. We could simply put up price and quantity boards, and the market would clear. But if people are constantly producing new things, then they have to talk to their potential customers to find out what their needs are. And having produced these new things, they then have to have a dialogue with their customers to tell them what the new stuff it is that they've produced. Relationships play a huge role in the modern economy. It's kind of hard to measure these things, but I would say they play at least as important a role as was the case 500 or 600 years ago. There are very few things that we transact in a truly anonymous market. I mean, maybe we buy stuff of eBay, and maybe we buy things of Amazon. But apart from that, most of what we buy and sell is embedded in ongoing relationships. We tend to go work for the same employer, more or less, every day. We could get our hair cut by the same barber. And again, the reason is that having these ongoing relationships economizes on dialogue. If the two of us are doing business with each other for a long time, we kind of know what each other means. And it also helps facilitate the adjustments that need to be made, because contracts can never be truly well specified up front. And then again, it hardly needs to be said that decentralization works only to the degree that it's tied to real responsibility. People will take their right to make decisions seriously only if they are held responsible for outcomes. So what does all this mean for the financial system? It seems the statement would seem to be uncontroversial, at least the nurture part of it, that finance should nurture a dynamic real economy. But it was only 3 or 4 years ago when a blue ribbon panel comprising many of my friends from down here and from Columbia and from Harvard declared that the American financial system was terrific because it produced high-paying jobs for financiers. We may laugh, but that's what they said. I think most of us would laugh today. If we don't think of a good correctional system in terms of the employment and incomes it produces for prison guards, nor should we think of a financial system in that fashion. Really, we've got to ask, what does a financial system do to nurture innovation in the real economy? And I would argue that this nurturing requires mirroring. And it's not merely because I believe in symmetry. There are good fundamental reasons for this. Think of how the need for finance arises in the first place. The need for finance typically arises through an on-the-spot forward-looking judgment made by an individual or a business. I apply for a mortgage if I have my wits about me, after walking around the neighborhood, after figuring out, after studying historic prices. I make a judgment that prices in this neighborhood are not about to collapse, and the price that I'm offering for this house is not ridiculous. I also make a forward-looking judgment about the soundness, about whether my job is a good job or not. Because if I'm likely to be laid off in 6 months, or if I'm going to suffer a large pay cut, then I probably wouldn't be able to afford a mortgage of the size that I'm applying for. And therefore, if I'm making this Hayekian on-the-spot judgment about what kind of mortgage to apply for, a good mortgage lender also ought to be making the same kind of Hayekian judgment. A good mortgage lender ought to get inside my head to understand what the specific facts that led me to make this judgment are, and then either agree with my judgment or disagree with my judgment. Similarly, if I am applying for a working capital loan, I'm making a judgment about the soundness of my business, whether my competitive position is robust, whether my customers will continue to buy, whether my business will grow. And therefore, a banker deciding whether or not to extend me this working capital loan has to, again, get into my head, understand in fine grain detail what my assumptions and my calculations were in applying for this working capital loan. So judgments require judgments. And these judgments can only be sensibly made through a process of dialogue. How does the banker know what my assumptions were about my house or my business? By talking to me. There is no other way. And typically, because most finance is not extended for overnight periods, it is very, very rare that the bargain that was struck at the outset can be maintained through the life of the loan. Frequently, the need will arise for adjustments. My business may do better than I had anticipated, and I'll bump up against my credit limit, and then the bank has to decide whether to increase my credit limit or not. Something may go bad. I may violate a covenant. Again, the banker has to figure out whether to waive the covenant or not. And these kinds of adjustments are best made if the banker has had an ongoing relationship with me and has gotten my measure, as it were. And then again, nothing more needs to be said. That just as these decentralized judgments in the real economy work best when there's a tie to responsibility, likewise the financiers capacity to make good judgments ought to be tied to real responsibility as well. Now, this general picture of what good finance ought to look like has not vanished. It exists in small business lending. It exists, interestingly enough, in venture capital. So venture capitalists who finance the most technologically advanced businesses in the world still make their investments in a rather old-fashioned way. They actually get into the innards of people's business plans. They have conversations, deep conversations lasting weeks, months, sometimes a year. They have relationships. They sit on companies' boards, so when the next round of financing comes up, they have some sense of whether the business needs to be given more money or not. And so this kind of mirroring finance does exist. But unfortunately, in my view, that's not where the growth in finance has been. The big growth in finance over the last 20 or 30 years has been of a pathological nature. It's been the replacement of decentralized finance with highly centralized finance. It's been the replacement of judgment with mechanistic models. It's a process which has more or less eliminated dialogue and relationships, and it has almost again as an inevitable consequence of decentralization and concentration has made the tie between responsibility and authority remote. Let me focus on two crucial pathologies. One is the mass production, judgment-free explosion of asset-backed securities. I said earlier that decentralization, even in the real economy, is not absolute. And indeed, some degree of centralization has been necessary for our increased standards of living. So railroad cannot be run in a hierarchical fashion. It needs a centralized authority to run the railroad. And just as you have centralization in the railroad finance also needed some degree of centralization. You could not have the individual venture capitalist or the neighborhood bank investing in a railroad. You needed a railroad bond. And so this kind of centralization of securitization per se is not new. But there is a fundamental difference between issuing a bond there are multiple and important differences between the bonds that were issued to finance railroads and the bonds that were issued that were backed by car loans and by credit card debt and by mortgage-backed securities. One important difference was that although there was some centralization in the issuance of the railroad bond, because you were delegating considerable responsibility to the underwriter and you were delegating some responsibility to the credit rating agency, it was not judgment-free and it was not dialogue-free. The underwriter had extensive conversations with the company issuing the railroad bond and did a case-by-case analysis, sort of got into what competition the railroads faced, it got into what traffic patterns were, got into whether the pricing could be maintained or not. The credit rating agency might have the same kinds of conversations and it might enter into a negotiation. Well, if you add such and such covenant to the bond, then we'll give you a high credit rating. With these new asset-backed securities, there is no dialogue with the final borrower. There can be no dialogue. It's sort of it's one step removed. There is no judgment. The judgment is simply how does this look in terms of a statistical model, and crucially, there is no economy of scale on the side of the asset being issued. Now you can say that there is no way a railroad could be financed by a small bank, but there is certainly every way in which a car loan or a mortgage can be made by a local banker. So the alleged economy of scale in this kind of asset-backed financing lies not on the side of the asset being securitized. It's not that the railroad is indivisible. It is allegedly a process of efficiencies being realized in the process of granting the finance itself, and this process of creating this efficiency involves the elimination of judgment. The same kind of judgment-free mechanistic explosion has been seen in asset-backed, in complex derivatives. Till the early 1980s, there were basically no over-the-counter derivatives to speak of. That number, there were bond futures and there were currency futures traded right here in Chicago, but there were not these complex derivatives. These derivatives exploded from roughly zero in the early 1980s to about 100 trillion in 2000, and somewhere between 600 to 800 trillion in 2006. Trillion, not billion. How was such an explosion even possible? It was possible because we pretended that no judgment was necessary, that people didn't need to know anything about what was going on in the real economy on either side of the transaction. There were these master contracts which nobody actually read or understood, and then there were the whiz kids who, through the sort of the press of a button, could tell you how these things could be priced. And this, in turn, has led to concentration, inevitably so. When finance was principally an activity which involved case-by-case judgment, the investment, and so we had investment banking partnerships. They were necessarily small, because you had maybe 100 underwriters. Each of them was going to go out and investigate the railroad. That kind of organization cannot be very large. You had the shoe leather lenders. Span of control arguments meant that the boss of the shoe leather lender could only supervise only so many bankers. But now, if you say we have mechanized this stuff that is just like an industrial process, you don't really need to, you can supposedly manage by the numbers. So the stuff is produced by the numbers, and the argument is that the people producing the stuff can also be managed by the numbers. No judgment of subordinates is necessary. In fact, what this does is that it creates, it certainly allows a large number of activities to be shoehorned into single organizations, but it also leads to ineffectual top-down management. We have seen allegations, and I have found it hard to believe that they're not true, that we've had robo-foreclosures in violation of the law, where people were signing off on thousands of foreclosure documents in violation of rules which said you're supposed to actually know the facts before you sign off. People like Jamie Dimon and Vikram Pandit and the people who run these big outfits can very legitimately say, we didn't approve of this, we don't know of this stuff. And it is indeed true. How could they know? When you are running financial organizations of such enormous complexity and scope, how is it even possible that the people running it can actually know what is going on? Likewise, regulatory oversight has, for all practical purposes, disappeared. Time was when bank examination meant an examiner walked into a bank and said, show me your loan files. And typically, a bank examiner would look at every loan file, a business loan file in a branch, and look at perhaps half the loan files having to do with consumer debt. And you'd sort of go through the full record. Today, a regulator walks into a bank, and Goldman Sachs, a Citibank, a JP Morgan, what does he or she see? He or she sees these enormous banks of computers. These computers have terabytes and terabytes of data inside them. How on earth is any kind of oversight of what is actually going on, what risks are embedded in these institutions even possible? In the establishment's assessment, this is a terrific thing. It's more, cheaper credit. It's just as Henry Ford invented the assembly line and made cars affordable for all of us, so also have the securitizers invented a process by which car loans, not just cars, can be mass produced, and therefore the cost can be reduced for all of us. And this is from a paper which is allegedly critical of the financial system in 2005, again from my friend down there. Financial innovations have produced beneficial real effects, increasing lending, entrepreneurship, and growth rates of GDP, while reducing the cost of financial transactions. Only a few years before this, Raghu and his long-term colleague Luigi Zingales told us that capitalism was was threatened by capitalists, and the only things that would save us was the financial system. We don't hear very much of that anymore. Now, it is no doubt true that the costs of financial transactions have been driven down to virtually nothing. But where is the evidence for the rest of it? Remarkably, this particular paper at least does not seem to have a whole lot of footnotes on this argument. And again, it is alleged that these new innovations lead to better risk management. Donald Cohn, in a rebuttal to Raghu, said derivatives in fact had enabled risk and return to be divided and priced better to meet the needs of borrowers and lenders. Ben Bernanke, 2006. Banking organizations of all sizes have made substantial strides over the past 2 decades in their ability to measure and manage risks. Concepts such as duration, convexity, and option-adjusted spreads provide better risk returns to stockholders and greater resilience of the banking system. My goodness, imagine what would have happened in 2008 if we did not have these things which made the banking system resilient. But we did. There are those of us who think that there is a significant downside to robotic centralization. I believe that there's serious misallocation of capital. And the misallocation of capital arises for exactly the kinds of reasons that Hayek talked about. Once you eliminate case-specific factors, you will give mortgages to people who shouldn't get mortgages. And you will not give, and doing that will price prudent borrowers out of the market. The model cannot distinguish between the income of an automobile worker whose plant is scheduled for closure next month, even though it's been announced in the newspapers, and the income of a federal judge. As far as the model is concerned, income is income is income. The model cannot distinguish between the mortgage loan applicant who came drunk to apply for a mortgage and the applicant who became sober. And it's exactly as Hayek said, when you rely on a system of decision-making where you pass on just 4 or 5 highly abstracted facts to a central planner, you will make bad decisions. It's precisely this has occurred with, substitute the central planner with a model and you have pretty much the same thing. I'd also argue this has led, I couldn't prove it, but it seems reasonable to believe that this system has led to a neglect of real enterprise. Put yourself in the shoes of the CEO of Citicorp or JP Morgan, or pick any large financial institution bank that you can think of. On the one side, you can expand your lending to small borrowers. That's a pain. You have to hire hundreds of bankers, you have to put them through a training program, then they have to go out and sort of look for borrowers, and when a loan application comes in, it has to be put through a credit committee and so on and so forth. It's a very slow and painful process. And to the degree that your bonus is tied to a share of the bank's profits, it's a slow way to grow your bank's profits. Much, much faster to get into the securitization of mortgages, because it doesn't require training anyone it requires someone to create a model on the one side and a bunch of hustlers to go out and peddle mortgages and have people fill in forms, and in fact they don't exercise prudence, they coach you in how to fill in those forms, and soon enough you have a gigantic securities business. It requires very little to create a 10, 20, 30, 40 trillion dollar derivatives portfolio. A few rocket scientists, a modest investment in computer capacity, and bingo, this. I mean, you don't have to hustle, you don't have to be bothered by managing people. And in 9 years out of 10, this thing has fantastic returns on equity. Oh well, in 1 year out of 10, it does really badly. But in those 9 years, your share is fantastic. I mean, I haven't done the numbers on this, but if I had to hazard a guess, Jamie Dimon's income, all told, is probably 10, 100 times the income of the CEO of JP Morgan in the early 1980s. Is the man really adding 10 to 100 times the value? Or is it that we've just sort of we've blown this thing up? In addition to misallocating capital, I argue that this process also leads to instability. Human judgment certainly is fallible. You have thousands of lending officers making case-by-case judgments. Some proportion of them are going to make mistakes. Some proportion of them are going to lend to borrowers whom they shouldn't lend to. But when you substitute that with virtually identical lending models produced by people who went to basically the same schools, learned the same statistics, looking at the same data, if there's anything wrong with those models, even if their incentives are perfectly aligned, they are going to crash the system. I also suspect that this is a process that has led to increased herding and increased correlations. The argument for mortgage-backed securities in terms of the soundness of banks ran roughly along the following lines. Mortgages in Boston are uncorrelated with housing prices in Boston are uncorrelated with housing prices in Chicago, are uncorrelated with housing prices in San Francisco, are uncorrelated with housing prices in Houston. And guess what? There's never been a nationwide housing downturn, decline in housing prices since perhaps the Depression. So wouldn't we have much sounder banks if instead of holding a portfolio of Boston mortgages, that Boston Bank swapped out its portfolio of Boston mortgages with a nationally diversified portfolio of securitized housing loans? Safe as houses. What is wrong with this argument? Well, many things are wrong with this argument. One is simply carelessness. Human nature being what it is. If you tell me that this asset is something which is likely to go down, I'm going to be pretty careful, and I'm going to hold it on in my portfolio. I'm going to be pretty careful in terms of what I put on. If you tell me I have instead a bulletproof portfolio, because everybody's told me that it can never go down, why should I bother? Secondly, I think once you start moving away from case-by-case analysis, be it of mortgages, be it of stocks, be it of commodities, you tend to increase the correlation of things that were hitherto uncorrelated. So you could say that when people did case-by-case analysis of stocks, stock prices move to a considerable degree independent of each other. Therefore, if you held a diversified portfolio, your risk was not going to be that great. However, imagine what happens when everybody buys into that argument. When everybody believes that stocks are simply an asset class, and what you're merely buying into is an asset class, there is a natural tendency whereby all stock prices tend to start moving in tandem. You've seen this in the commodities market as well. The commodities market used to comprise pork belly specialists and grain specialists, and they kind of knew what the supply and demand factors were in each of these markets. And along come geniuses who tell us, oh no, commodities are an asset class, all you need is a certain exposure to that asset class. People pile on, and suddenly stuff which was uncorrelated starts becoming correlated. And instead of reducing the risk of the system, this increases the risk of the system. And finally, I believe it jeopardizes the legitimacy of capitalism in some deep and fundamental way. Whether people explicitly think about this or not, I think the wealth accumulation in the American capital system has not been regarded as something bad, because we fundamentally understand that wealth is accumulated by creating value for the public at large. So the two Google guys may make $10 billion each, but if you add up the value that has been secured by the hundreds of millions of users of Google, and you add up the little pennies and nickels and dollars that they have realized, that sum swamps the wealth that has been that has been secured by the people who started Google. And there's quite a bit of research which suggests that 95% of the value of innovations is realized by the users of innovations, and only 5% is captured by the producers of innovations. So some of us celebrate the fact that wealth is accumulated through innovation, and there are those of us who may not go out and sort of pound the drum and say this is a great thing. We think it's generally okay. When you get to a system where the common belief becomes that this is a scam, that it was one thing when the partners of Goldman Sachs and Lehman Brothers, etc., made $400,000 or $500,000 a year. Maybe it was too much, maybe it was too little. It was fine. When we're now talking about tens of millions of dollars, and people cannot see any link between this vast explosion of OTC derivatives, the wealth that is realized through this vast explosion, and their well-being, they begin to think that the whole game of capitalism is there's something fundamentally wrong with it, and that, I think, is probably the worst consequence of this financial crisis. What are the causes? This is, I think, what for me was the most fun part of the book. So I argue in my book that this being enabled by bad finance and economic theories that ignore the multifaceted, unquantifiable uncertainties that we all face. I wasn't going to get into it, but let me just toss this out. All of you take risks day in and day out, hour in and hour out. You took a risk coming to this talk. Maybe you'd be bored out of your minds. You'll take a risk when you order at a restaurant this evening. I would suggest to you that perhaps once a year, once in 10 years, you try to quantify these risks. Because and that is not because you haven't been taught about probability and statistics. I would suspect everyone in this room has. But because you're dealing with the kinds of situations where it fundamentally makes no sense to try to quantify. Life is not a roll of the dice, or the same roll of the dice, especially in a dynamic economy. Things are changing so much. The change is routine. What is new is routine, and therefore you cannot deal with these new risks in a statistical way, drawing upon this, the historic patterns. One deals with risks in a holistic fashion. But that's not what these mechanistic models do. The mechanistic models also assume away differences of opinion because they're a pain in the neck to deal with. And they fundamentally assume away dynamism. When I was writing this book, I had a conversation with a famous economist who shall remain unnamed, not from down here at Harvard, and he said, yes, your stuff about judgment and all may be fine, but it's, that's only for venture capital. The economy as a whole is fairly routine, and it's the same thing which happens year in and year out, and you can reduce the stuff to statistics. And I said, no, you can't. I mean, we're eating in a restaurant. This restaurant has to every day figure out whether its menu is good or not. Every day it has to figure out whether there's another competitor who's opened up a shop around the corner. And what is true for the restaurant is also true for the banker to a restaurant. But this kind of stuff interferes with this mass production. Mass production is facilitated if we assume that statistical patterns will repeat. It's just not true. Likewise, I argue that we face a problem of misregulation. This is where I get into where I get my friends on the right to gulp and try to ignore me. So I argue, as I made the argument earlier that as technology advances, there's a general need for more rules. Invent cars, you need traffic police. But it is not the case that all new technologies and all new advances demand the same degree of new regulation. So you can have a personal computer industry with virtually no regulation. All you need is for the producer of the personal computer to submit a model to the FCC. The FCC tries to figure out whether it interferes with radio transmissions or not. If not, it sends it back, and that's about the sum and substance of regulation with personal computers. With automobiles, you need a heck of a lot of regulation. I mean, you could not imagine rules of the road arising through spontaneous order of the sort that Hayek extolled. I mean, if you want to see what happens when you have spontaneous order, go to India, and nor can you have spontaneous order deal with brake safety. I mean, it's one thing to deregulate trucking prices. Thank God we didn't deregulate the inspection of truck brakes. So I argue that in finance, there are certain aspects of finance where extensive regulation is not necessary. In particular, I argue that securities laws were probably not called for in the early 1930s. And securities laws, for all practical purposes, didn't exist till the early 1930s. They were very likely an overreaction to the great crash of 1933, and they unfortunately became progressively tighter. So the securities laws are like sort of regulation of PCs. On the other side, I argue that banks are like automobiles. They really cannot function without extensive regulation. In the 1790s and early 1800s, when virtually no other commerce was regulated, people kept a very close lookout on banks. There were certain states which actually banned banks because they realized that the capacity for banks to do public harm was enormous. And it took somewhere between 100 or 135 years till we got a sound system of banking regulation. I think by 1935 we had largely a good system of banking regulation. Unfortunately, we weakened that sort of year in and year out, starting the 1970s. So the stuff which didn't need to be became tighter, and the stuff which is crucial became progressively looser. So, but that's like 7 or 8 chapters, so it's a very thumbnail sketch. So what now? In the establishment's diagnosis, it's just sort of the innovations in finance were fundamentally good. It's just that regulation fell behind. Barack Obama, before he became president, said old institutions cannot oversee new practices, implicitly saying that the new practices are good and it's the old institutions that have fallen behind. And Ben Bernanke continues to insist financial innovation continues to be a tool for making our financial system more efficient as long as regulators are more alert to its risks. It sort of begs the question, well, he was, why weren't they? And then Tony Blair, after having told us why regime change in Iraq was such a good thing, tells us that credit default swaps and derivatives are not in themselves a bad thing. So what do we get from this perspective? We get the insider cure, we get modernization, we get the Dodd-Frank Act, all 2,300 pages of it. It has the stuff, the Financial Stability Oversight Council, the new authority for the SEC and CFTC, a code of conduct for all registered swap dealers. Imagine if we'd had a code of conduct. A federal standard for all home loans, we're tinkering with regulation of asset advisors, we have an office of credit rating agencies, and on and on and on it goes. It's fairly sleep-inducing. And it's worthwhile to note that the 1933 Banking Act was only 37 pages and you could actually read it. This is 2,300 pages and it's virtually unreadable. From the point of view of skeptical outsiders, that's me, this kind of regulatory catch-up is both futile and it's pointless. It's futile because there just aren't the people around. you'd have to hire every PhD, I think, from every PhD economics program in the world to be able to staff up to do the kinds of things that the Dodd-Frank Act says we are supposed to do. Secondly, I think it's a continuation of a top-down approach that we've tried for decades and it's failed. So, like I said, till the early 1980s, bank examination was bottoms up. It was case by case, shoe leather. The examiner came in and looked at the bank's loan files. As banks started doing stuff which was unexaminable, the regulatory response was not to stop them from doing stuff that was unexaminable. It was to sort of throw up our hands and say, well, we'll do this through capital requirements. So till the early 1980s, there were no uniform capital requirements for banks. An examiner would go through a bank's books and at the end of the examination would say, given what I think of as the riskiness of your portfolio, this is the kind of capital you should have. But that was sort of a footnote, as it were, to the regulatory process, not the main event. What we said instead was, oh no, we can't examine, so we're going to specify different capital cushions for different kinds of categories of risks. So if you have this category of risk, then you'll have this amount of capital, and if you have that category of risk, you'll have that amount of capital. Again, on the assumption that everything in that category is a draw from a uniform distribution. Of course, this led to a game, which is you tell me that this category requires less capital. I'm going to A, load up on that category, and B, I'm going to load up on as the riskiest things that I can find in that category, and that fails, and then the regulator says, oh no, let me subdivide that category into subcategories, and so on and so on. It goes. It's a futile process. And then finally the question is it worth doing? We spend an awful lot of money regulating automobiles and trucking. We hire traffic police. We invest in we invest in safety inspections because we think that the system of transportation provides economic value. So it's worth it. So if it were the case that hiring every PhD from every economics program was shoring up an activity that had demonstrable value, it would be one thing. But we have seen no evidence that this explosion of new stuff that has occurred over the last 20 or 30 years creates any value. And so in the normal course, I would never say, you an innovator, justify what value you create. I mean, if people want to create pet rocks and there are willing buyers who buy pet rocks, sort of God bless both sides. But if pet rocks need heavy regulation and you need the expenditure on making pet rocks safe, then I'm going to ask whether pet rocks produce value commensurate with the amount that I would have to invest to make pet rocks safe, and that evidence simply isn't there. As Paul Volcker says, the only financial regulation that I can think of in the last 2 decades that has any value is the ATM. So let me offer a retro-radical alternative. It's radical in the sense it breaks sharply with Dodd-Frank. It breaks sharply with all the Squam Lake crowd. It breaks sharply with Basel, and it's retro in the sense that it, to a large degree, takes us back to the kind of banking regulation that we had in the 1950s and 60s. And the general principle is case-by-case enforcement of broad rules. Go back to on-the-spot examinations, not top-down edicts. And the model I have in mind is the way we administer justice in this country. Congress passes laws, there are common law precedents, but each case is decided by a jury, taking into account the specific facts that are put in front of the jury by opposing lawyers. So we don't simply rely on a mathematical process and laws. I mean, we don't convict people based on a model which says there's an 82% chance within a 5% degree of probability that you're guilty. We look into the case. Now, of course, this kind of case by case tends to be labor intensive. So you cannot have a case by case system of regulation unless you also limit the effective scope. And I would argue, I couldn't prove, but history suggests that the thing we really ought to focus on is maintaining a sound depository and payment system. And oh, by the way, if you do that, you will also provide credit within prudent bounds, and you will contain speculative manias. The interesting thing about bank regulation in the 1950s and 1960s is that it did not lead to a low rate of growth of credit. Credit expanded in the 1950s and 60s at about 9% a year, which is 3 times the rate of growth of GDP. And yet there were no bank failures. So it wasn't like the system induced such conservatism that the expansion of credit stopped. No, credit was expanding pretty nicely, thank you very much. But because of this case by case, the number of bank failures was virtually non-existent. So here is my specific, modest, quasi-libertarian proposal. Depository institutions, which as a short form I will call banks, ought to be very severely circumscribed and regulated. The only thing they ought to be allowed to do are simple loans and hedging operations. And you'd say, but they will figure out a way around this stuff. I say, no, we have a pretty simple standard. And the standard will be what a college-educated regulator can understand. So a regulator walks in, says, you're doing stuff I simply don't get, therefore you shall do no more of it. Pretty much, end of story. I'm not smart enough to know what you guys are doing, therefore you won't be allowed to do it. Perhaps we also need something like a prudent lender rule, that if these cases ever get litigated, what the financier would, or what the banker would have to prove to a jury is that this is the kind of loan I would have made if it were my own money. Shut down money market funds. They do none of the above. They are a parasitical free-riding institution against which a bank which has a prudent lending operation cannot compete. So anyone who raises short-term funds from the public has to play by the same rules, which is has to extend credit in a defensible, prudent fashion. Perhaps the time has also come to reassert a full government monopoly over money. The notes in my wallet are explicitly the liability of the government. Why aren't all bank accounts explicitly the liability of the Treasury? And what fundamentally is the difference, especially in this day and age, between money that takes the form of paper, which is guaranteed, and money which has this nebulous status? It's kind of half guaranteed, it's kind of not half guaranteed. In times of panic, the system collapses. Why not just be straightforward about it and say all short-term deposits are like Treasury direct accounts, whether they are individual deposits, whether banks deposits against other banks, whether they are businesses deposits in banks. And let's be honest about it. On the other side, I would say leave all these hedge funds and investment banks alone. It's no additional oversight is in any sensible world possible, because they're going to scam it. They will get around it, and it's not even necessary. As long as, and this is a really important, as long as there is no credit or counterparty exposure with respect to regulated institutions. So think of, again, my most recent favorite example, automobiles. There are certain cars, we say, that are so powerful and so unstable that we deem them to be not street legal. We don't ban them, but we say they're not street legal. These things can be taken on Formula One racetracks and can be raced around at crazy speeds by crazy people wearing helmets, under rules laid down by Formula One. So let's do the same thing. Let's keep the high-powered Formula One type of finance off the public roads, off the depository system. Let's not ban it. Let them go do their thing in the arenas where they can play either with partners' capital, or they can play with with long-term funds raised. In writing this book, I contacted a former boss, and I said to him, I said, he had created the interest rate caps and collars market in the early 1980s. So I said, Paul, why is it, and he was at Citibank at the time. At the time, Citibank and Salomon Brothers pretty much owned this market. So I said, why is it that the sharks at Goldman Sachs, because everyone knows they're sharks, let you guys own this market? And he said, the reason was pretty simple. Citibank was and is a publicly traded company. The CEO had no clue what we were doing, and he didn't care as long as we turned in our P&L numbers. Salomon Brothers had by then also become a publicly traded institution. Goldman remained a partnership. The partners tried to read the derivatives documents. They said, we don't understand these things, and we're not putting our partners' capital against stuff that we don't understand. How far we've come from there. So they are very happy to put up the public's capital in the form of their equity capital, and more importantly, they're happy to lever up 30 to 1 from essentially taxpayer subsidized credit and counterparty guarantees. Take these guarantees away from them, let them do what they want, and I assure you, we'll go back to we'll still have the Formula One stuff, but there'll be a few cars, and it won't be a whole heck of a lot. So let me conclude by urging you to focus on what is really broken. There's a deep-seated pathology of centralized finance that needs to be attacked. That stabilizing the status quo ante, which is what a lot of my friends in finance argue for. Oh, we're never going to bring the economy back unless we bring back the securitized debt market. No, it's dead. Let it stay dead. And on the other side, I say, let us protect and nurture decentralized innovation, which is the ultimate source of modern prosperity and a good life. Thank you. Happy to take any and all questions.
Should I take a list of questions, or do we want to just, what would be your preference?
So I actually gave a talk in San Francisco where I saw the most disciplining mechanism for question taking that I've seen, but I'm not suggesting we do it here. No. But there, people had to write down their questions on a piece of paper, hand it to the chairman. This automatically shut off the speech making, masquerading as a question. But that's fine, we won't do that here. I'd rather actually answer questions one by one because I have a very volatile short-term memory. And
we're all reasonable people here.
Right, okay.
I have a question, but I don't want to. I won't make a speech. I'll be very quick. And it's a little unfair because it's about the pathologies of finance, which you didn't talk about as much in this talk, but I think it's absolutely fascinating. The question that I have is, why have such self-evidently flawed models come to form the backbone of the American financial system, when, as you make clear in the book, there are a set of simple alternative rules of thumb which perform equally well, if not better, and are based on much more realistic assumptions. So there's something about economists and the power of economics which I have trouble understanding. I'm a political scientist. Nobody reads what we do. No one cares what we do. Why do people care what economists do if their assumptions don't match reality and also don't seem to produce very good outcomes?
So there are vast tracts of economics which don't match reality and which are harmless. Mm-hmm. Most of game theory is pretty harmless. It does. It doesn't match reality, and it's sort of ask yourself the question: what would have happened if the Nash equilibrium had never been invented? Nothing would have happened. The world would have.
We wouldn't have that movie.
We wouldn't have had the movie, but it so happens that there was this peculiar combination of a regulatory ethos, a deregulatory ethos, in the 1970s. That in late 1970s, late 1980s, that meshed very well with the kind of stuff that had been going on with in finance for quite a long time, for 15 or 20 years before that. So let's take the seemingly something which might have been otherwise quite harmless, the Markowitz method of looking at risk. Is everybody here familiar with? No? So a normal person looking at risk, sorry?
No, he's talking about the
Right, a normal, I mean,
efficient portfolio theory.
yeah, but it's a whole sort of way of thinking about risk, which is, most people, you say, well, if you had asked a traditional banker, what is a risky loan? And you'd probably get a long list of what makes a loan bad. It doesn't necessarily mean a loan whose principal goes to zero from one day to the next. It's a loan where the guy misses payments, where the borrower becomes a pain, etc., etc., etc. So a bad outcome in the normal course has this fuzzy, broad character to it. If you ask a venture capitalist, well, what's a bad investment? Well, I mean, one extreme is an investment that goes to zero, but there's an awful lot of stuff which is a bad investment from a venture capitalist point of view. I suppose many of you hire employees, and you say, well, what's a bad employee? And you probably give me a long list of what makes a bad employee. You certainly would not reduce it to a number. And likewise in finance as well, the idea of associating a bad investment with, you ask, well, what's a bad investment? Something which loses money. Along comes Markowitz, creates this completely artificial universe which does not exist in reality, and says, in this universe, I can reduce risk to a number, and it's called the variation in the prices of your portfolio. So, gentlemen and ladies, you don't need to know anything about the individual risks of stuff in your portfolio. All you need to know is this one number, and then this general way of looking at risk pretty much permeated the entire system of finance. And why did this happen? Because it was aided and abetted by regulation. So in 1975, a change in ERISA rules said that that the prudent man rule, which said that the trustee would be responsible for looking at the risk of each asset. They said, well, we don't really need to do that as long as the portfolio is adequately diversified and you look at risk at the level of the portfolio, then you're fine. This approach to managing risk, which showed up as value at risk metrics, etc., again was embraced by banks because they were allowed to do it. If you had the system of the system of examination that existed, and banks weren't allowed to get into these over-the-counter derivatives, and Goldman Sachs had continued to sort of say, no, we won't take the kinds of risks that we don't understand. This whole thing would have been a footnote. I mean, it might have existed in small corners of, but once it was, I mean, I have to admit, I once ran, I was a sub-hedge fund manager, and I had constructed a very elaborate fixed income futures-based portfolio based on these Markowitz's methods, because I too had been seduced by the math. So it's sort of, but suppose I hadn't been allowed to. So it's now why an interesting question which isn't in the book is why is it that universities and academia have embraced, especially in the social sciences, have embraced sort of the natural science model of knowledge accumulation rather than the engineering model is a truly interesting question, which is that for my sins I went to an engineering school, And we had this fat handbook called Perry's Chemical Engineering Handbook, and it was basically a very large number of heuristics. And you wanted to design a reactor. You sort of turned to so and so page, and it told you what. And there's no science beneath it. It was just a whole bunch of ad hoc rules, graphs, and so forth. Time was when finance textbooks had the same character. They were like sort of Perry's handbooks. But we went from there to where finance professors used to produce sort of this ad hoc, low-grade engineering style of knowledge, to these fancy mathematical models which mapped into a world which does not exist and to a large degree cannot exist. Why that happens, you pretty much have to look into how provosts think, how universities think, etc., etc. Sorry, that was an incredibly long-winded.
Just to answer your question quickly, there's also, I heard some talk recently in the media that how the field of economics has been polluted basically by the financial industry because of the incentives that there are in consulting agreements and others for economists to be able to basically come up with metrics that are actionable for the people who are involved in finance. So they actually have internalized the values of the financial system, and that basically shows up as science of economics in their work. So, but yeah.
I think that may have reinforced it, but it started before this. So the Arrowization or the Samuelsonization and the de-Knightization or the de-Hayekization started 50s, 60s. Now, it certainly got a huge boost because of the money that was in it. I mean, no doubt about it. And sort of the finance professors started treating themselves as a superior species because they got paid so well in doing this stuff. So
or it could also be a part of just trying to appear more scientific.
Yeah.
You know, most disciplines have what is called the physics envy. So that's, you know, trying to be as scientific as physics.
I think that's actually, I'd argue, one of the main problems is that people applied exactness from financial models to markets with human nature being what it is. I just think the fundamental fallacy in assuming, I mean, so and there's a lot of discussion to be had on that point, but trying to, like you said, people like formulas. People like VAR because it was simple. It's just one number and you're done. People didn't realize that markets are not normal. So
in academia, you get tenure if you prove theorems.
Right.
You don't get tenure if you just do some empirical study and publish it.
Right.
That's regarded as low grade research.
I mean, incidentally, engineering schools are not immune to this. I had a conversation with a professor at Caltech, and I said, "What do you think of who is a great professor at Caltech? Is it a great scientist or a great engineer?" And she said, "Without a doubt, it's a great scientist. If that science happens to produce something useful, that's fine. But we aren't going to reward people. We're going to reward people for advancing science. But at least in engineering, to do engineering research requires large grants. To get large grants requires you to sort of prove to your grant-making entity that there's something useful which is going to come of this. So finance research is too cheap in some sense. You don't need a grant, and you can charge high tuition, so it's sort of self-sustaining, and you're off to the races.
Are you familiar with Saskia Sassen's argument about financialization of the economy?
I should be, but I'm not, since she's the latest member of the Center on Capitalism and Society. So, right. So I should be familiar with her, but she's a sociologist, and I shouldn't.
Well, it's basically the argument is that the financial system. I mean, she makes this distinction that you make between the real economy and the financial system, and she's basically saying that the financial system has kind of grown around the economy, has put its tentacles in different parts of the economy, and it's designed to just extract value from different parts and reward people in the financial system. And so that's why our metrics for the financial, for the real economy have kind of been changed, and actually we're almost in an illusion where we're mistaking the financial system for the real economy. And she's basically saying that we need to in order to get the real economy back, we need to definancialize the system. And so, just roughly.
Yeah. I think there are a fair number of people. I mean, Adair Turner has said this, Paul Volcker has said this, Mervyn King has said this to a degree. And the $1 million question is how? Right? I mean, how do you bring the financial system, I mean, how do you bring the real economy back while concurrently allowing finance to shrink back to the size it was 10 or 20 years ago? That's the challenge. Yeah?
What would you do with the 401k system in which millions and millions of people are invested in companies through really no decision-making process that can trace? You invest in a lot of portfolios and companies, and so some people, I'm sure, pick very specifically, but most people are just not choosing what they're investing in.
So I think that system is a consequence of a very large number of rules that were imposed with the Securities Acts, and so I mean, things which seem relatively innocuous and good are not, or at least have a downside which is underappreciated. One, for instance, most people sort of think of, is it a good thing to throw insider traders into jail? And are rules against insider trading a good thing? Most people would say yes. But then you sort of start thinking a little more closely about it and say, well, these insider rules essentially penalize insiders. And one obvious consequence of this is it creates a disincentive to be an insider. So likewise, good disclosure. Absent a system of good disclosure, people would sort of demand before they made investments access to people's books, conversation, dialogue, etc., etc. You tell people this disclosure is really good, and it's so good that if someone even lies a little bit, he's going to be sent to jail. Then you begin to get confidence in this disclosure system. So there is, I think, a serious downside to these securities rules that have made securities markets so liquid. I don't think we're going to do anything about it. I have hopes that we could re-regulate banks. I have no illusions that we will do away with insider trading laws or securities laws. But specifically on what one does with fiduciaries, I think a simple reinstatement of the old prudent man rule would go a long way. So if you said to a fiduciary, you have to be personally have done good due diligence on this business, and you ought to be familiar with it, etc., 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 you'd get back a lot of this stuff, I think.
Actually, so full disclosure, by the way, Amar knows I'm in the capital markets, and one of the reasons I'm there is thanks to Amar, because you may not remember this, but 20 plus years ago, I'd asked you if I'd go into M&A or capital markets, and you told me capital markets.
High returns, I was right. You know?
So it's kind of interesting to listen to you, and I mean, there's a lot to talk about. It's a fascinating subject. And I think I actually agree with the premise that judgment is important. I agree with your recommendations about separating FDIC insured banking from the rest. And I think to some extent that's becoming one of the themes that's coming up. My question to you is that are you carrying the idea of judgment too far? I mean, I'll pick the example of, you mentioned 401ks, which are kind of mutual funds. I think of whether it's mutual funds for stocks or asset-backed securities for credit card loans. Just take those two examples, right? Judgment can be exercised one-on-one, as you said, or potentially could it not be exercised where, and I'll throw in one more thing, which is the law of large numbers, right? I mean, insurance is based on the law of large numbers. It's been for centuries. It seems to have worked fine. I'd be curious to know what your thoughts about that are. But when you take an asset-backed security as an example, the reason why it's supposed to work is that, again, there are lots of issues with loans in Massachusetts not being different from loans in California. Correlation is a big issue. Grant you all that. Well, let's just take credit cards, because I think it's a little simpler. You can get a very wide demographic of people who borrow on credit cards. And you should be able to make the case that if there's, there's a level at which if there are 50,000 borrowers and a portfolio of X billion, so I'll try not to make a speech here. The law of large numbers should work, so the judgment is exercised in the following way, that people who are buying into those securities, as long as they feel comfortable that the math was done right, that it makes sense, and so the judgment is transferred, if you see what I'm saying. So you made a statement on asset-backed securities, so just specifically, does judgment have to be one-on-one? Banker making a loan to a person, or can it be done in a transitive way through a system?
So I do, in fact, I actually had spent 5 pages on insurance and why it's special. That my editor unfortunately cut it back to 1 page. And insurance is special in a variety of ways. One is that you're largely dealing with a stationary phenomena, which is sort of, or at least an incredibly slow-moving phenomena. You're dealing with a phenomena where the risk is borne principally by the person buying the insurance. I mean, the insurance company's only risk is the person stops making the payment. The third is both by convention, which is socialization, training, and to a large degree by regulation. What insurers can do is very tightly controlled. So, the argument that you're making to me was made by one of my former McKinsey colleagues who had spearheaded this system of securitizing credit card debt, and he said he had proven to the chemical bank through data that a model was better, a mathematical model was better than this biased, judgments of the lending officer. And my answer was simply this: that you're not dealing with a stationary phenomena as you're dealing with when you insure life loans. When you insure life loans. So what happens when you prove, quote unquote, that your judgment is better? You then start extending the stuff based on a model. Two bad things happen. One is that the people who get the credit figure out how to game the model in a manner in which a person who's getting life insurance cannot game the model. B, everybody else starts using the same model as well. And then the same historical facts which sort of proved that this would work without this led to better outcomes start being undermined, because the dynamics of competition will inevitably drive the credit card model to a place where it begins to fail.
So actually, 2 points. Are you shutting down credit cards too and credit card securities both, or neither?
No, I the two go hand in hand, by the way.
Well,
they go. So there is a distinction between consumer loans and credit card debt, and there's a distinction between, even if you were to extend credit cards, to extend a credit card based on sort of knowing the borrower, and sitting on the balance sheet of the bank, and again, case by case. So And interestingly, if I may, since you raised the issue of securitization, one of the things that lending, according to formula, does is that it facilitates securitization in the following way, which is, if I'm securitizing a loan, where you say, how is that loan made? And the answer is, I exercise my judgment. You as a buyer of that securities pool say, oh, who's he? What's. If on the other hand, I can provide to you the mathematical model on which that loan was based, and I can provide to you the 6 items of variables, then I don't care about whether judgment, who made that loan. So there's in fact a very tight nexus between the process by which by which the original loan itself is extended in a mechanistic fashion, and your capacity to securitize it. But coming back to your question of and the third big difference between credit cards and insurance is that the risk lies on the financier side, not on the borrower side. So let me offer you a couple of cases or sort of examples which prove my rule, where you can make credit decisions without any case-by-case analysis. One is margin lending for stocks, and the reason you can do it, and the only conditions under which you can prudently do it, is if there's a rule which says you can lend no more than 50%. Mm-hmm. So you don't get into this because if you didn't have that regulation, one margin lender would begin to compete with the other margin lender, and we sort of end up with a race to the bottom. Likewise, when you had tough loan-to-value ratios, and you said, well, you must have at least 20% equity, right? Then if you lent, and this was imposed by federal law, then if you lent based on a formula, then you weren't going to be in much risk. But typically, in a competitive credit market, unless it is buttressed by a vast number of these other kinds of top-down rules, which I am not, loan-to-value rules or 50% margin rules, you will, over time, what seems to be working, the law of large numbers will eventually come and kill you, because the law of large numbers applies to what happened in the past, and the future keeps deviating from the past because of competition.
So so you would not have securitization markets, period, for any kind of asset class? Is that
no?
Kind of
Securities markets where
securitization, I'm talking about.
Securitization of, well, again, being Hayekian, I think my judgments tend to be frequently wrong, right? And so there may be some fantastic mathematician who comes up with a great way of, using God knows what, which I have not foreseen, etc., etc. So I don't want to ban securitization. I want to get the depository system out of it.
Oh,
that's
I think
that's
agree with
right.
That.
So I tend to be skeptical about securitization, but that doesn't mean that leads me to a public policy posture which says ban securitization. Yeah.
I have somewhat unrelated question. Whether would you have any comments or thoughts about the U.S. healthcare system? Which is supposed to actually eventually break the government or exceed cost.
So there's some things that are too hard. Afghanistan and Iraq are too hard. The healthcare system is too hard. Global warming is too hard. My mind isn't good. Isn't swift enough. Finance is easy, and it's really dumb that we aren't sort of fixing what is really easy.
Do you think, by the way, Volcker is kind of, in the last few days you may have seen, he's trying to say that the Volcker rule should be applied without specific hard and fast rules. Was he influenced by your thinkings? Because it's pretty much on the lines of what you're saying. Keep the rules somewhat open-ended to allow for a lot of flexibility.
So,
and by the way, the Republicans have come out against that already.
Yeah. So my Hayekian view is loved by Republicans. The conclusion is not. So what can I say? So the reason Volcker's blurb ended up on the back is that someone had sent him a copy of the manuscript, and he I think Ned Phelps may have sent it to him, and he called up Phelps and he said, "Who is this man Bhidé?" He said, "He's provided the intellectual underpinnings for things which I believe in my gut." So
he did. It is exactly on the same
right.
lines.
So it's
because if you have rules, then, and I've worked for banking for long enough, people find a way to get. You will arc the roof. That's what people are trained to do.
And to some degree, even if with case by case, there will be some examiner who's more lenient, there'll be a crooked examiner. I mean, all kinds of things are possible, but at least it isn't it won't be done in a centralized, on a mass scale.
I think we should wrap up. But thank you so much.
Thank you.
For the presentation, and appreciate everyone.
Thank you.